Jordan Lulich. This is the Lulich Corner, and today I get to sit down with Jessica Buskirk, who is a certified
public accountant.
Certified public accountant. I just lost on that word. A CPA. I always just say
there you
CPA.
go.
A CPA. And Jessica primarily works with people who are real estate investors or in the real estate industry. So I am super excited about today's conversation. Jessica, thank you so much for coming on, for making the trip, for taking your time to share your wealth of knowledge in this area. Because we've worked in the past, and I know you're just very, very knowledgeable in all things CPA relating to real estate and real estate investments. I'd love for you just to introduce yourself to the audience, and then we'll really dive into what we're here to talk about today.
Certainly. Well, thank you for having me. My name is Jessica Buskirk. I am a CPA local to this Treasure Coast area. I have a virtual CPA firm, which is something that kind of got inspired after COVID. And so I work with clients all over the United States who are in all facets of business, but I mainly focus on real estate investors. So I'm really excited to be here. It kind of fits with what you do.
So I get this question asked a lot, tax planning. And I feel like most CPAs out there, you're either a tax planner or you're helping people prepare returns or do books.
Right.
But very seldomly do I see someone who is giving proactive tax planning advice and also helping with the books, helping with the returns, and helping with that. So it's awesome that you've got a knowledge in both of those areas. And so who, from an income perspective, when does tax planning come into play? I mean, what type of, would you define it by the amount of income in a given year, or when should somebody start to consider tax planning?
I mean, I definitely think probably income does play a factor for sure. But I feel like, pretty much anybody can, benefit in some factor. Even if you're a W-2 making $40,000 a year, you could contribute to your HSA or a flexible spending plan. I mean, there's still opportunity there. But when it would make sense to hire a CPA to try to get advice is when you start having more complex situations, like you're a business owner or you're investing in real estate. Or your portfolio of investments period make a lot of income where you're needing to try to reduce your tax burden. And so often, I get people who come in and like you said, they haven't been proactive. They're CPA, they're lucky if they even talk to them all year long.
Yeah.
So I do agree that's a piece that's missing. And I think a lot of times we're so overburdened with just doing the returns and keeping up with the day-to-day that we forget that everybody doesn't have the same knowledge that we have, and we need to educate.
So what would you say to someone who maybe is just starting to explore tax planning? Like what type of strategies do you approach, and like what type of consideration should people give on trying to find a strategy as far as tax planning goes?
Yeah, I think the most important thing is to focus on tax planning throughout the year. So often people don't do tax planning until year's over and their taxes are due, and they're like, oh my gosh, what can I do different? Well, the year's over. You know what I mean? There's very little we can do. We could do some retirement investment or something like that before your taxes are filed. But really, you're kind of, it is what it is because the past has already happened. And so my suggestion is if you are looking to either get into some type of investment or you're trying to get into tax planning, is to find a CPA that you fit with, that really makes sense for you, that you just feel like you connect and that you are able to learn from them. Because sometimes, maybe you're catching on with everything that I'm saying, but I talk to somebody else and even my husband and I swear everything I say is foreign to him. So It's like, it depends on, some people just don't connect. So you want to find that person that you really connect with that will offer tax planning and strategy planning with you.
Yeah.
And then just really be open with them. So often I have clients who just don't think to tell me everything that they have going on. They tell me this much. Well, to be able to do tax planning, I need to know the whole story. I need to know. And honestly, I ask goals, what are your goals? What's your 1-year goal, your 5-year goal? Because all of these different strategies that you might put in place, it kind of could play on what the future is. So, putting a strategy in place that might not work if your plan is to completely pivot in a year, it won't make sense. You'll spend money or you'll spend time implementing something that's going to be obsolete the next year.
So what are the top strategies for real estate investors? I mean, let's dissect that a little bit. I know you talked how to approach it, but when you actually start talking about implementing tax strategies throughout the year, how can people minimize their tax liability in April of the following year.
Yeah. So, I mean, depending on how they're structured, that's probably the number one tax savings that I get with clients is looking at their business structure. If they're structured as a single member LLC and they're doing flips, say, and say they're bringing in 150,000 in profit at the end of the year and it's all sitting there flowing through onto their personal, all of that is subject to self-employment tax, where we could evaluate, like looking at their whole picture, would it make sense to change their structure as far as not changing it from an LLC to an S corp, but electing to be taxed differently as an S corp? Right there could potentially save you an additional 15.23% of self-employment tax on the portion you're not taking as a W-2.
And then I know someone for like who maybe even if they're in the real estate industry and they've got a consulting business or some type of
100%.
a consultative business, one of the best strategies I've seen is, yeah, set up an LLC, elect as an S corp, pay yourself a payroll because then
Right.
you're paying yourself at a lesser percentage rather
Exactly.
than paying on the distribution of profits that would come out of the LLC, and set up a payroll,
Yeah.
have some type of salary that you're paying self instead of taking all of those profits from the company. So
100%.
I know that is, I see, real estate agents, I see real estate investors, consultants, I see that as being a really one of the first steps that people take is getting a payroll set up.
100%. And I mean, getting a payroll set up if you're just a single member LLC isn't going to do anything for you because it's going to be obsolete. But you're right. If you make that S election or you
Right.
initiate as an S corp, then it definitely can save you a ton of tax. Like, I mean, I think I did one not that long ago, and this year we were able to save them like 52,000 in
Wow.
self-employment tax.
Wow.
Yeah,
That's
and that's,
awesome.
I mean, they were bringing in a ton, and it was just all being subject to self-employment tax. So it's just, that is like a really simple change. I mean, like it's simple. If you're making a certain amount, I would say if you're profiting 50,000 or above is when you start seeing that shift, that the savings is more than it's going to cost you just to have it, the self-employment tax would cost you.
Most people I work with, I see like kind of like the go-to tax election I see is an S corp.
Yeah.
When would people consider that C corp or that corporation as a tax election versus an S corp?
A lot can play into that. There's definitely strategies with C corp. I would say you're much bigger. You are going to be very proactive in trying to take advantage of all the benefits that you can as a C corporation. There are things you can do to be able, like your goal as a business owner is one, to grow your business, but
Right.
two is to be able to take some of that profit for yourself. And as a C corp, your C corporation is going to be taxed at whatever I think it's like 21% right now. And
Then you're double taxed.
yeah,
on
then
the
you're going to be
distributions.
taxed again. Any distributions is dividends to you.
Yeah.
And because you're literally a shareholder, just like you would be a shareholder at Apple or any of these other different companies
Right.
that you buy shares for. So definitely, I think you would have to be proactive with like fringe benefits and there's a lot that your C corp can pay for that a S corp can't necessarily pay for. So definitely making sure that it would make financial sense to you to incur some of that double taxation.
Interesting. Okay. So what about some other than the structure of your business entity? What are some other like actual tangible tax strategies that people can implement in their businesses?
Yeah. So small businesses, some of the low hanging fruit, even if you're an S corp or not an S corp, is, people forget about, we talked about hiring your children, finding ways that you can hire your children to work for you. Whether I had somebody who showed properties and did different things and did a lot of marketing. And so she put her kids in the marketing, and so there's different ways that you can find and justify ways to pay them that they're actually doing the work. So the thing would be, if you do that, you have to have a job description. You have to have a reasonable salary or hourly rate for them. And then you have to track their time, that it's legitimate and you're paying them. So you would want to talk to your CPA to make sure if you're paying them as a contractor, what does that amount have to be? Because you want to keep it under the limit where it's actually beneficial to you.
They don't have to pay taxes on what, like the first 14,000 or 12,000?
Whatever that standard deduction is for single that's kind of their limit. You want to keep it under that limit, and then potentially you could say your young children, say that there was ways that you could find that you can implement them into working for you in some aspect. You could hire them, do that, and then invest that money into like a Roth or something like that, where eventually you're looking at it never being taxable income. You know what I mean? So that's a really great strategy if it's something that you're wanting to do.
Yeah.
Other things that people forget, is just, I would say the biggest thing is record keeping. I know that sounds like, oh, so, duh,
Yeah.
but people spend money on their business constantly and they don't think to record it or to keep track of it. And meanwhile, they're using their personal credit card or Home Depot card or debit card. And it's not on their business, which one, we know that's a no commingling funds.
Right.
But it happens. I would say 99% of the clients I work with, they
Wow.
just teaching them to not commingle. When you lose out on those expenses, you're not going to, at year end, when you're trying to put together a financial statement because you haven't kept track of anything all year long, going back through all your personal stuff plus your business stuff, it's a lot. So you lose out on a lot of expenses, and you think you're keeping track of them all, but you aren't. Home office expense, some people don't take it. They have never taken it, and they come on and it's like, well, there's like a really easy, if you really have a designated home office, take advantage of it. I mean, that's
And
like
can
simple.
you do that if you have a physical office, or does that have to be your primary office?
No,
at
if
your
you
home?
are working, they base it off of the square footage of the home and the office and how many hours you're working in it. So
Okay.
if you're doing half the time in a home office and half the time in your regular office, you can justify that. You just, like I said, you'd have to kind of have an idea of what your hours are in the
Interesting.
office, and it kind of just calculates on a percentage basis of what you can deduct. I mean, but every dollar counts, right? And then there's just the standard of the simplified method of you get so much per square foot, period.
Right.
Like, it doesn't matter about anything else. You're just taking that simple
Right.
method.
Even if you have the 5,000 square foot office at
Yeah.
home.
well, it limits it on, I think, 150. I'm not 100%
Yeah, that's what
sure.
I'm saying. Yeah, it's got to be a reasonable space.
Yeah, exactly.
So a lot of people are talking about cost segregation studies, and using cost segregation studies to take advantage of the bonus depreciation
Yeah, for
rules under
sure.
the IRS. And so if someone's buying a home that's for investment purposes, there is a way to depreciate a substantial amount in that first year
Yeah.
by doing a cost segregation study.
Certainly.
And so what type of depreciation can they take advantage of in their first year doing the bonus depreciation
Yeah,
under the IRS rules?
For sure. So, I mean, just for those who don't know what a cost segregation study is basically they go and look at the investment property, and they're going to break it down into different years of life. Like appliances might be 5 years, flooring might be 15.
Yeah.
And so they break it all up, and then you have the highest depreciation, which is the building and the structure, 27 and a half years, and then your land. So they give you a study, literally like a packet, telling you what all the dollars are for each depreciable life. Anything 15 years or less, up to a certain dollar threshold, you could bonus depreciate, which could definitely help somebody who's a real estate investor.
Right.
And what that would allow you to do for 2025 is you could depreciate 40% of those expenses upfront in that year. So really strategizing and knowing, like, say you're doing 5 flips and making a ton of money that year, or maybe 10 flips, who knows? And there's a lot of profit, and then you do the cost seg to offset it. I mean, it will help you kind of balance out your income, because you're going to have this loss on the property, which may not mean that you're not cash flowing on that property. It just is a loss from the depreciation. And so this is one of those things that I know Trump is trying to put back. It sunsets this
The 100%. Yeah.
Yeah, so this year is the last year if nothing changes. So
Well,
then
it's gone down each year, right?
it does. It was like 100.
80,
Yep,
60,
exactly.
40.
So this is 40 now.
What does that amount to over a few years as far as a percentage of the purchase price? I mean, does it, do those a personal property and those things that you can take that bonus appreciation, does it equate to like 20% of the purchase price, or 25% or 30?
I mean, I've seen huge, like larger complexes that have, it's been almost like, I want to say 70%, which was shocking to me. I've seen it as big as that.
Wow.
But I think it depends on what all's in it, how big, there's so many things
Yeah.
that I'm not privy to. I have no idea
Sure.
how they come up with the numbers, but somebody does. And so,
Yeah.
I've seen it as large as that. I've seen
Yeah.
it, and the biggest thing that you want to look at if you're doing the cost seg is, one, do you qualify as a real estate professional? And that means that one, have met the hours. There's like a 750 hour limit. There's, you're doing this more than 50% of the time. There's like a test of several things you materially participate and such. So you definitely make sure you qualify, or else if you do all that, it's going to be lost because you can't use it.
Right.
And then the second piece is, making sure that the savings that you're looking at, like they can sometimes estimate what they think it will be.
Okay.
And you can talk to your CPA saying, this is what they're thinking is going to be 15 years or less. This is, how much will that really save me versus how much is it costing you?
Because the cost segregation study would be $3,000, $4,000,
Yeah,
$5,000.
exactly.
Right. So you want to make sure that you can save 10, 15, 20.
Exactly.
don't
You
wanna
want to save more.
Yeah, you don't want to save 4. Yeah, exactly. Because it's going to take
Yes.
some process and time and energy for everybody to do
Exactly. And that you have other income that is worth offsetting in that year,
it.
too.
Right.
So
Absolutely. if you were to take a loss that year, could that loss carry over to the
Yeah, you
following
can
year?
carry forward.
Okay. We are out of time. Jessica, thank you so much for coming
No
on. If people
problem.
wanted to reach out to you, how can they find you and how can they contact you?
Yeah, you're welcome to email me, Jessica, period, Buskirk, Buskirk, at realtimecpa.org, or you can call me at 772-633-3041. Thanks so much for having me. I
All right.
appreciate it.
Thanks for listening in. I'm Jordan Lulich. This is the Lulich Corner, and we'll see you next time.